All right. So please, in the last class, quiet. In the last class, please note the question that towards the end, Saloni has asked a question and I have answered her. I've given some examples important for you to understand even the policy debate. We mentioned an important policy principle of freedom of contract, which is a feature of most of the developed countries. Actually, because the term has become set in the policy debate as freedom of contract, but actually it should be freedom to contract, to be strictly correct in English. But just say freedom of contract because that's how it's been understood in the policy debate. So I've given us some examples which you can relate to. What is meant by freedom of contract? I gave examples of the Swiggy discounts, the Amazon discounts, which the government is trying to crack down on. So please try and understand this principle of policy, the policy debate that we had on that particular principle. Everything that I've discussed with you basically emanates from some principles. Okay, so understand that, watch that, listen to that last part of the part where she's asking this question and I've answered her. Okay, so let's go back now. So we have already covered this. So we covered the part which talks about the two differences. We looked at the differences between exchange traded and OTC markets, and then we looked at this was 26, and then we ended the segment, okay, by talking about those two differences, which I'll just briefly go through, but you should cover that on your own. The second part we discussed. First is how we are blurring the distinctions on the point of the management of credit risk. And we discussed three different ways in which that is happening: collateralization in bilateral situations, and then bilateral collateralization situation initiatives like CME Clearport, and then the CCP, which the regulators are imposing on the OTC market participants in standardized contracts. Okay, and then we also talked about flex options, which the CME is using, which is basically an example of how exchanges are trying to reach out to the OTC market participants and bring them to the exchange space. Okay, so this finishes this topic. I've given you an optional topic, which is basically a further development of this point. The second point we discussed on this topic is blurring of the distinctions, new developments. Okay, and then what are the limitations on the blurring of the distinctions? It may be a little bit difficult to understand, so I've left it as an optional topic. If you want, you can read it. Okay, basically because it's about the point of standardization of contracts. So unless you standardize the contract, you can't have, it becomes difficult to clear it centrally. Okay, so to the extent that you have high customization in OTC contracts, that becomes a limitation on using central counterparties or any other kind of centralized clearing system, because for that you need a fairly standardized contract. Okay, so the more customized the contract, the less amenable it is, the more difficult it becomes to blur the distinction on point number 4, which is the credit risk intermediation. Okay, so this is anyway as an optional topic. You can read this for yourselves. Now, our next topic, I'll just briefly cover this for you, because you guys are actually going to be doing a project, which is okay. So this is quite big. Do I have? Let's do 50% and then zoom in. Oh my God, it's too. Okay, I'll just explain this to you. This framework has been put into your folder, so you can have a look at it. So there's no need for you to look at it in detail. Okay, I mean to note it down. Just try to understand the schema here. This is not working out very well. I think we'll go to 50% and then. All right, and everyone can see this now. What is Garvit looking at? Let's have Garvit's phone also. Let's have Garvit. Give me the phone as well. Garvit's phone. Quickly. Can everyone see? Shreya, can you read the writing? Tax, legal and regulatory. Puneet, can you read the writing?
No,
Okay, got it. Okay, I understand the problem. The colors should not be there. So, format options. It's very difficult now to fix this. Okay, let me just tell you something. 1 minute. When you read it, when you see it at home, you'll be able to get it done. 1 sec. Let me not. Okay, let's not. Let me see if I can do something about the colors. Okay. Oh, here it is. Okay, here it is. No, it's not working out. It's not working out. Okay, I don't know how I did this, but let's not.
You can just tell.
Yeah, I'll just tell you guys. Okay. Please try and pay attention. Try to understand here what is happening. How much can you actually read? Okay, so you can't read the activities, but you can read the other stuff, right? You can read increase risk and reduce risk.
Yes.
That stuff you can read. It's just become too. What happened? Okay, guys. Now let's just one sec. I'm not able to manipulate this picture now. Okay, let's just try and understand quickly what it is, just for your own understanding. Okay, I'll read out the segments to you. What are you working on, Shivam? What are you working on?
I was thinking of
Okay. All right, guys, please pay attention. Try to understand the scheme here. It's just to show you guys, because you make sure that you guys understand what the functions of the treasurer. So here we are just going to call it CFO because it's a much smaller word. Okay. So in a large corporation, you might have both a CFO and a treasurer. The CFO will tend to concentrate more on account preparation and those kinds of things, whereas maybe some of the tax related matters as well, whereas the treasurer will tend to focus on the fundraising and the cash management and those aspects. Okay, so when you see it on your laptop, you'll be able to see it clearly. So what we have written down here is basically this. I'll just read out the stuff that you can't see properly. So this is written as funding business units. These things are actually the activities which the CFO has to do. These things in yellow and the one in blue is the activities that the CFO has to do. Okay, so when I say CFO, it's an aggregate of CFO, treasurer, everything combined. So this is capital raising, this is funding business units, this is cash management, and this is risk management. Okay, and this is tax, legal, and regulatory. So I'm sorry, the fonts are not good, not big enough, and so you can't see it. But anyway, so these are the activities. Now there's a reason why I put this in blue. The reason this is in blue is because this is written for MBA students. Okay, so tax, legal, and regulatory, one of the jobs of the CFO, one of the functions of the CFO, that whole group of people is tax, legal, and regulatory, and that includes preparation of financial statements, which is a big activity actually. Okay, preparing the financial statements is a big activity in any CFO operation, and that is covered under regulatory because most of those are regulatory filings. Okay, so the financial statement preparation is either covered under tax also. Sometimes you have two P&Ls, one tax P&L and one management P&L, and for reporting P&L, because tax laws may give you some other kinds of benefits. So you have all that is covered under regulatory. Financial statement preparation is covered under tax, legal, and regulatory. The reason that's in blue is because those jobs are not given to MBAs. Those are usually given to either LLBs or CAs. So you are either a qualified lawyer or a qualified accountant, and then you get those jobs in those departments. Okay, so tax, legal, and regulatory has therefore been put in blue. Okay, and the other activities which are given to MBAs when you go into a corporate treasury, corporate CFO operation, those are put in yellow. Okay, which is here once again I'm repeating: funding business units, capital raising, cash management, and risk management. Okay, so the scheme here is just to show you how the activities of the CFO are intertwined with the objectives of the firm. Okay, that is the whole idea about this framework. Okay, so you don't have to note anything; it's in your folder. So what we have tried to show here is how the firm is caught between, caught having to walk a tightrope. It's caught between conflicting objectives. The first objective, obviously, every firm is a profit-making. Most of them are profit-making profit-oriented organizations. So they have to grow earnings to make money, right? And so to grow earnings, you have to increase risk or reduce risk. You have to increase risk, because if you want to make more money, you have to increase risk. Like any coffee, let's say barista, like a coffee chain wants to increase earnings, it will have to set up a new outlet. One of the things it will do is set up a new outlet which has certain fixed costs, and when you set up a new outlet, you have no real guarantee as to how much money that thing is going to make. Okay, you don't know what the footfall will be, how much people will spend on average. Nothing is really known for certain. But what is certain is your costs. When you take a lease, you can't take a lease for like 15 days. So you'll have to take a lease for 1 year, at least maybe. Okay, so your 1 year lease rentals are certain. Then you have to hire employees. You can't hire people for 7 days. So you'll have to hire employees. So all those costs are locked in, and all your sort of overheads are locked in, and those are guaranteed, but your revenues are not guaranteed. Okay, so that's the basic risk of any business. Okay, so you have to take risk. So what we are trying to show here is that when the firm tries to grow earnings, it has to increase risk. Okay, I don't know if you can read the increased risk here. Can you read it, Puneet? You can read it? Okay. All right. So to grow earnings, you have to increase risk. Okay. But then you can't just try to grow earnings like our good friend Kingfisher Airlines. Okay. Or people like ILFS, all these people who got into trouble. Okay. And I think what is the other company that recently got into trouble?
Carvey stock broking firm is also facing some issues.
Carvey is actually, that's a compliance failure. They haven't like gone bankrupt.
Sir, but they have actually.
DHFI is also another example. Yeah.
Sir, they have compliance issues, but what they did was they took the money of their clients, the securities of their clients.
Okay, quiet. When person is speaking, give her the mic.
No, sir.
Okay. Why you don't like the mic?
Yeah.
Use the mic. What is the problem? You feel shy using the mic. You have to get used to it. No. You have to get used to it. You can't be shy using the mic. You're a business student. You're an MBA student. Next time we'll make you conduct the freshers party or something. So you have to get used to it. You can't be shy about it. Okay. 1 minute. Be quiet, please. Yeah.
So I was saying that what they did was they took the securities of the clients, they transferred it on their name, and then borrowed loan from banks and other financial institutions. So that was the kind of fraud what they did.
Yeah, so there's all kinds of problems there, and the first compliance problem is, as a securities firm, you have to understand, there's always, in most countries, there is a bar on commingling client funds with the firm's money. Okay, so when you have client funds, like we showed you that day, the clearing firm system, remember, when you're trading with brokers on the stock market. Okay, so those brokers are members of the stock market, stock exchange clearing house. Either you're broker directly or you're dealing with an IB, and then the IB has an account with the clearing firm. But the rule always is that even the clearing house cannot commingle, the clearing house doesn't do any proprietary trading, but the clearing members cannot commingle the client funds with their own funds. So that's one mistake that they've made, and then the other stuff which they've done is even bigger problems. So anyway, okay, so the point I was trying to make is that you can't just keep on taking risk and end up like Kingfisher Airlines. Okay, so you have to also focus on what we call staying solvent. Okay, are you following this? The other objective is you have to also stay solvent. While you want to make money, you have to also make sure that you're solvent. Okay, solvent means that you must have enough cash to pay your debts as they come due. Not with the rescheduling of debts or something, but with as they come due through your own money that is available to you. Okay, that you should be. So staying solvent, when you want to focus on solvency, do you need to reduce risk or increase risk? When you want to focus on staying solvent, do you reduce risk or increase risk? You reduce risk. Okay, so what we're trying to show here is basically that the firm is caught between two conflicting objectives. Every firm has to try and grow earnings. Okay, there's tremendous pressure, especially if you're a public company. There's tremendous pressure to grow earnings. So to grow earnings, you have to keep on taking risk. Okay, and similarly, at the same time, while you're growing earnings, you have to also keep an eye on solvency. Okay, hey, why are you taking your phone? Keep it here. Don't go out. You're very restless. We'll have to, don't come back quickly.
Don't come back.
So, again, he left the door open. Okay. We'll have to put a bar on him going out now. Okay. Okay, guys. All right. Now, what was I saying? Okay. So all we are trying to show here is to show you how, and then we'll see how the CFO's activities are intermingled with this, okay, are connected to this. So the firm has conflicting objectives. On the one hand, it has to grow earnings, and to do that, it has to increase risk. On the other hand, it has to focus on staying solvent, which all requires you to reduce risk, okay, so that you have not taking too much risk and you don't go bankrupt, or you don't go into insolvency. So there's a conflicting objective. Now look at this. While how do the activities of the CFO mesh in with the objectives of the firm? Okay, so when you try to grow earnings, there are two types of growth: organic and inorganic. You guys know the difference? Yes, Anjum, tell us the difference on what is the difference in organic and inorganic growth. Give her the mic. You're going to go into corporate treasury, right? So give us the lowdown on Gulati is laughing, so he'll tell us after Anjum. No, let him answer first.
Sir, Gulati will go into the IT side. He's not going to go in corporate treasury.
Okay, answer. What is the answer?
Sir, can you please ask a question from IT?
One minute.
It's a request, sir.
Anybody? Okay, Anjum, you don't know? Organic versus inorganic growth, you don't know? Haven't you guys done a course on M&A?
No, sir. No, sir.
Yes, sir.
Okay, give it the mic. Okay, quiet. Anjum, give the mic to Chuk. Give the mic to Chuk. Yes, quiet. Everybody quiet. Yeah. What is the difference in organic and inorganic growth?
So when the growth is supported by when the growth is supported by acquiring another company, it is known as inorganic growth.
Okay.
And organic growth means that you have grown on the basis of your retained earnings, on the basis of your it simply means you have grown apart from acquisition.
Okay.
Okay.
Okay, yeah. So you could have explained it a little better, but you have understood the concept. So organic growth means that growth. It's like just Apple is setting up another Apple store, opens an Apple store in Bangalore, okay, which never existed. So that is organic growth, because Apple is remaining Apple, but Apple is just expanding the scope of its operations. So it sets up a new store in Bangalore, a new store in Jaipur. Okay, these are examples of organic growth where the company is expanding through its own by expanding its own operations. Inorganic growth is if Apple buys, let's say, a Swatch, which is a watch company, okay, Swiss watch company. So if Apple buys Swatch, okay, and tries to blend their, come out with now fancy watches and stuff, and thereby increases its sales, that is called inorganic growth, because they're actually coming through the growth of another company. Okay, is this clear? Okay, so it's kind of natural, and you can think of M&A as a slightly unnatural activity, which it requires some effort to acquire a company, whereas natural growth is happening on its own. Okay, so you can relate it to organic and inorganic chemistry, which you studied in. So now have you understood organic versus inorganic? You mean to say this was never taught to you?
Yes.
Everyone's forgotten. Okay, all right. Okay. So now here, once again, guys, please come back to the schema. Okay, try to understand how the objectives of the firm. So you see, growing earnings is one of the objectives, and there are two ways to grow earnings, either organically or inorganically. Okay, in both cases, you need to have capital raising. You need to raise capital, because either you grow, if your Apple is opening a new store in Bangalore, they need money for that. Okay, so you need to either have that money or you need to raise that money. So capital raising is associated with both types of growth, organic and inorganic. Inorganic also, if a company, like now there's a you may not have heard about it, but there's a company, there's a big online brokerage called Charles Schwab in the US. And so as finance students, you should be aware of it. Charles Schwab is going to buy TD Ameritrade, which is another online brokerage. Okay, so and then there's another big merger also that has come in, which I'm forgetting the industry, but there's another big merger which came out before this. Okay, so these mergers keep happening. So when Schwab is buying Ameritrade, they need to that merger is worth, I think, they have to pay about $16 billion. Okay, so some of that will be paid through debt usually. Okay, so you need to raise capital to fund that acquisition. Okay, so Schwab may not have the money with itself, so it may have to raise money by going into the debt capital markets. Okay, and raising money. So you can see that capital raising, is it very confusing for you guys that I'm saying capital raising but you can't read it? Is it okay? Can you manage? Okay. So this part is capital raising. So this is one of the activities that are required, required of the CFO. Okay, in order to fund both inorganic and organic growth. In both cases, you need capital raising. So this is one of the most important activities of the CFO, raising capital, because everybody is hungry for capital. Okay, so this is a very, very important activity. And the second one is on this side, which you can see, which applies really to the organic growth side, which is funding business units. Okay, this you have already done in your FM1, FM2, I don't know which one, but your capital budgeting exercises which you did. Okay, so when you fund business units, like if you have a General Electric, which has many divisions, okay, so many of their divisions will submit their capital plans for the next year, and the CFO office in General Electric will evaluate the plans, see which ones are meeting the hurdle rate for the internal IRR or whatever, which is generating a larger NPV. So all this stuff that you guys did in capital budgeting, okay, all those skills, evaluating project analysis and all that, that goes into this kind of activity where the CFO has to decide, because there may be lots of demands for money, but you may not have that much money available. So you have to do some rationing, right? So there may be demands for $15 billion of new projects, but you may have access to only maybe $9 billion. So you have to decide which one to take and which one to reject. All right, so that's where so you have to connect your learning to the activities of the CFO. All the stuff you guys did in the capital budgeting, NPV, IRR, all that stuff, that goes into this kind of activity where you use those skills to evaluate proposals from the business units. Okay, you understand business units? Okay, a big company like GE will have an aerospace division, because they make aircraft engines, right? They'll have a medical equipment division, etc. Okay, so is this part clear so far? That we are connecting the activities of the CFO to the objectives of the firm and the activities of the firm. The objective is to grow earnings, one of the objectives. You grow it either organically or inorganically. Both cases you need to raise capital. So capital raising is one of the most important activities of a CFO. And the second is that you have to do some analysis, evaluate the various project proposals, and you have to fund the business units. Okay, so that's the other activity. This you've already covered. Okay, on this side, on staying solvent, you have two elements. One is cash management, one is risk management. Cash management, I'll give you some I'll give you some links, but we won't have time to cover it because we want to go for depth rather than breadth. So we'll cover risk management and capital raising in detail. All right. Okay. So on the staying solvent side, one of the most important activities is risk management. This part is risk management. Okay. This part is risk management. So here you have to manage your risk. All kinds of risks which you'll see when you get to do the case, which we are going to do in this project, in this course. You'll see what kinds of risk a company faces, but you already are familiar with the various types of risks. Yes. What are some of the risks we discussed? Right, market risk, credit risk, etc. And remember that if you go back to your market risk readings, if you go back to your OTC, one of the things that you have to remember is, things doesn't seem to be responding. Okay, when you go back here, you can see that I think towards the market risk is further classified. Okay, when you're talking about market risk, so most important types of risk are market risk and credit risk, but legal and regulatory, like what has happened in the case of Karvi, is a legal and regulatory risk. It's basically a compliance risk. Okay, they have failed on this point. Okay, so then you can have operational risk also, where you can end up, sometimes people have seen, there have actually been cases of remittances being sent for trillions of dollars when it was supposed to be millions because people added extra zeros. Okay, so these kinds of things happen actually. There was also a case on the Deutsche Terminbos electronic exchange, where a trader was sitting and relaxing like this, and his elbow was on the sell button, and he kept on selling contracts. And the market went into a tailspin because he sold so many contracts that everybody got spooked and started selling. So this actually happened on it's a Frankfurt exchange. Deutsche, used to be called DTB, then it got taken over by Eurex. So this actually happened, that the guy was sitting there. So these are all examples of what we call operational risk. Okay, so you have to be very careful. So now legal and regulatory I've seen, financing we've talked about a little bit. So market and credit risk are two of the most important ones. Okay, in your project we'll be dealing with market risk. So market risk, also remember, when you're dealing with market risk, okay, you will also have to further split it. We go back to our framework here. Okay, So when you are actually a market risk manager, so one of the job designations, one of the job descriptions that you will find in the industry in many financial institutions is risk management. Okay, so various types of risk manager, credit risk manager, and market risk management. If you're a market risk manager, usually in the big organizations, because the trading books are so big, they will classify it as a fixed income market risk manager, foreign exchange market risk manager, commodities market risk manager. All right, they will split it up because the books are so big that you can't have one guy looking at everything. Okay, but the concept in market risk is the moment you go into market risk management, you have to then visualize this kind of a framework where you are actually typically, if you're a foreign exchange manager, okay, foreign exchange risk manager, currency risk manager, you'll have to look at the spot trading book, you'll have to look at the futures trading book, the forwards book, the swaps book, and the options book. And in a very big organization, you may have separate risk managers for each of the books. Okay, so for every, so you'll have to look at the, so the point is that the moment you think about market risk management, you have to recall this framework. Because market risk management, when you have to put it, actually you have to put it into practice, you will have to go like this. You will have to go by asset class, and then you'll have to go by the market instrument combination. Okay, so you may have basically for the major currencies, you may have somebody looking at the FX option book. So FX options risk manager for the G10 currencies. Okay, so the major G10 currency pairs. Okay, so those are your markets, and your instrument is options, and you're confined to this. And then you look at the various aspects of the option trading book. So the idea is when you look at market risk, you have to immediately go back to this kind of a framework and further look at market risk comprehensively like this, across all the asset classes, across all the markets and instruments. Are you following? This is the idea behind market risk, because you may be running all kinds of books. Okay, book, you understand what I mean by book?
Yes, sir.
This position that you have, that's called a trading book. Okay, so in common, many people in industry, in especially the banks and the trading floors, this will be referred to as a risk book. Okay, so they will typically ask you when you're interviewing for a position, one of the questions they may ask you is, remember what I told you about sales, trading and research? Remember I told you sales, trading and research?
Yes.
You've forgotten that now. In any market making operation, which you will find, market making operations you can find in a commercial bank treasury as well, and you can also find in an investment bank or an investment bank trading floor. Okay, remember the market making operation which we discussed? What? Everybody's forgotten that? Yes? You remember? Sales, trading, research. What happened? Why are the responses are so muted? Why are the responses so muted? So in sales, trading and research, one of the questions that people will ask you if you want to, because many people just blindly say I want to do iBanking because they've heard that the salaries are very good. Okay, so you have to understand the role requirements are all very different. Okay, so one of the things they may ask you is, what is happening here? Now I'll have to start deducting marks if I see anybody looking here and there. Okay, because there's too much talking going on today. Okay, all right. So one of the questions they may ask you is, do you want to run a risk book? What kind of temperament do you have? Do you want to be running a risk book, or do you want to be in research, or do you want to be in sales? The temperaments are totally different. The required temperament is totally different. A salesman's temperament is totally different. Okay, and a research person's temperament is different. There's some overlap between trading and research because the analytical aspect is involved. Okay, you still have to basically, whether you're a research person or a trading person, you will always have to be engaged in this kind of activity, which is looking at a market and taking a view on which way is this going. Okay, which way do I want to bet? Is this market going up or is this market going down? That view you'll have to take whether you're a research guy or a trading person. Okay, in both cases you have to take that view, but the difference in trading is you'll actually have to carry risk. You have seen the situation. Did you guys feel uncomfortable if you were holding a position and losing money?
Yes, sir.
Okay, so that multiply that several fold, because this was not even real money. So when you have actually had real money on the line, that becomes much more complicated. Okay, so the difference between trading and research really is that the research guy doesn't have to live with that heartache of having to take a position and then the thing is going against you, and then you're wondering what to do. Should I cut it now, eat my losses, or should I wait for the market to come back? If you decide to wait, then the market may actually not come back. It may keep on getting worse, right? So there's no simple solution. Okay, you have to just deal with it somehow. You have to figure out a way to deal with that kind. It's a very unstructured environment. Okay, so you have to be comfortable with that kind of environment to be a trader, and you have to enjoy that kind of environment. So people will ask you whether you are you want to run it. So if you're going to be a trader, they'll ask you that that means you want to run a risk book. This is called a risk book. Okay, when you're running a trade, if you're either a market maker or a speculator, it's in the industry we say that you're running a risk book. Okay. So all right. So this is the point here that we were talking about. That when you do what was the thing we looked at? When you do market risk management, okay, you have to split it up further into all these asset classes, market instrument combinations. Okay, this is the way to manage market risk. Okay, and then you may be assigned to a very specific market instrument combination, which locks you into an asset class as well. If we go back to the framework now, what happened? We have to increase this a little bit. Little bit better now. Okay, now you can still read because this funding business units, I think you can read. Okay, now we were just here, okay, which is risk management. Okay, we'll try to keep it here. So this risk management, that is one of the other, so the two areas of the CFO that we're going to focus on in this course. Hopefully we have time to get into capital raising also a little bit. But the two areas we'll be focusing on, the two most important areas are actually capital raising and risk management. Okay, cash management is not so critical, but it can also add a lot of value, but we won't have time to get into it. I'll give you some links. Funding business units we're not getting into because you've already covered it in your FM1 when you did capital budgeting. Okay, so you've already covered it, so we're not doing it. So are you following now the scheme here? This is really meant for your understanding so that you have a sense of how what the CFO's roles are, what kind of roles MBAs usually would take up if they go into corporate treasury, right? So, so the roles you would typically take up is in this kind of a situation where you're evaluating business proposals, business unit proposals, or in capital raising, or in risk management. As you will see the confirmation of what I've told you. In both these cases, risk management and capital raising, you will have to take a call on the market. Okay, so if you look at now TNX is the US 10-year interest rate. See where it is now. Okay, so now let's say for instance this is basically the yield on the 10-year US Treasury note. Okay, so if you're raising US dollar debt for 10 years, this becomes an important factor in the calculation. So you can see even this very short period of time, it has ranged between around 325 to around 135. Okay, so 135 to 325, that's quite a big range in such a short period of time for debt instruments. Okay, that is, we are talking about the interest rate. All right, so the US Treasury is paying this kind of interest rate. This is a range of rates 325 and 135 in this short period of time, say about these 2-3 years. Okay, so this, if you are a why do I keep bringing you back to taking views on financial markets? Because if you are a treasurer, okay, if you're a CFO or treasurer, if you are raising capital, if you are raising debt capital, okay, if you are raising US dollar debt capital for 10 years, okay, this will be one of the key benchmarks against which your cost of funding will be measured. So as you can see here, this market is not standing still. Can you see that? The market is not standing still, and you can also see cyclicality in this market. Can you see that? Almost, not really almost a perfect circle, but somewhere there, okay? Some element of cyclicality you can see starts from a low level, goes up, and then kind of comes back, okay? So the stuff is moving around, and this is going to determine the way that corporate debt is sold is basically as a spread to treasuries. So you will have to see, they will see what, let's say if you're, say IBM, you're going into the market to borrow, you're working for the IBM treasury, and IBM wants to borrow money for US dollar debt for 10 years. They will look at, first they'll look at, okay, how much are we charging the US government? We are charging the US government, say 175 at this point of time. We're charging them 175, and say for the debt of IBM, since they're not as good as the US government, we are going to charge them, let's say 50 basis points extra. Okay, so you know what basis point is? 50 basis points is 0.5%. Okay, so then if the US government is paying 175, then IBM will have to pay 225. Okay, but then when the US government rate is 325, then IBM will have to pay 375. Okay, so therefore your cost of debt is going to be a function of the benchmark yield. That's why I keep saying that you have to keep taking views on markets, because as a treasurer, when you are going to raise capital, you have some window available to you. You can decide that you can raise it today, you can raise it 3 months later or 6 months later. Okay, so therefore you have to take a view. If you decide to issue your debt today, that means you're saying that this rate is likely to go up. Are you following what I'm saying? Why are you issuing the debt today? Why are you not waiting? It must mean that if you are going in for an issue or date today, which means that your view is that these rates are likely to rise now, unless it's a situation where you desperately need the money, in which case you don't have a choice. Okay, but if we know that you don't desperately need the money and we see that you're issuing debt today, that means your view is that these rates are now likely to go up. Okay, if you felt that the rates are likely to go down, you would not be issuing it. You would wait because your total cost of debt will be lower, right? So you can see how in capital raising, which is one of the core functions of the CFO, that also requires taking a view on markets. Okay, and the situation of the Snap CFO we have already explained to you. If that Snap is the parent company that owns Snapchat. Okay, so Snap actually got its approval. They got their IPO approval they got it before the election. Okay, so this is 2016. They got their approval somewhere, I think in October. Yeah.
Kanika just called me, so
Where is Kanika?
I think she went out.
Okay, go. Okay, so they got their approval sometime in mid-October. Okay, and they could have waited through the election. Okay, or they could have done it before the election. I've discussed this with you many times. Remember? Are you guys following what is being discussed? What? You're looking all blank.
Yes.
You're in the situation of the Snap CFO who has received the regulatory approval to issue do an issue of equity shares. Okay, so you have a choice now. You have let's say you have a 6-month window. You got your approval in mid-October 2016. Now November 2016, you know the election is coming. Okay, so people are saying that Trump will not win, but if Trump wins, the stock market will crash. Okay, so now you're really worried because now you don't know what to do. Should you now do your because if you raise your capital now, it's fine. If the market crashes, at least now you would have raised a lot of money before the market crashes. This is clear. But if you don't raise it, if you don't raise money right now and then the market crashes, then you're in trouble because people will say you're an idiot. Okay, but then if you decide to raise capital now and then, as we saw, Trump won and both the predictions went wrong. Okay, he won and the stock market started rising. Okay, so in any case, if you decided for some reason to do the issue before the election and then the stock market started rising, then people will still say to you, well, you're such an idiot, you should have waited. Okay, so hindsight is always 20/20, as they say. So as a treasurer, you never really have, as a CFO, you never really have any peace. No matter what you do, people will be second guessing you after the fact and saying, well, you're such a fool. You should have seen that, you should have waited. You should have seen that, you should have waited and let the market rise. Okay. So the point is that because obviously, are you able to follow that you get a higher valuation if the stock market overall is higher? Every company gets a higher valuation, right? So the point is here, the point here is that in capital raising, you have to continuously take views on markets. Okay, whether you're raising equity capital or debt capital. That is why in these finance electives, I force you guys to look at actually to manage portfolios and risk books to get a feel for how markets actually move, so that you can develop your own way of navigating markets. Are you following? Okay. Alright, so we have established this point. So one of the important jobs is risk management, and whether you're managing, we'll come to risk management, how it's relevant. But essentially capital raising, you have to take a view on markets, and risk management also, as you will see, you will be required to take a view on markets when you're managing what we call a passive risk book. Okay, so is this point clear now? This framework is clear? Okay, so it's just meant to give you an understanding of how the firm has different conflicting objectives and what the main roles in treasury, corporate treasury are. Okay, so now we'll try to move on to our next topic, which is basically understanding futures contracts. Okay, so we have so we have this reading given to you. Let's first open your What happened? Now you're also going out. You already have 2 people out.
Yes, yes. Sir, actually, Kanika is not one, sir. I have to go to washroom. मुझे वॉशरूम जाने का इतना कोई आईडी नहीं है।
Okay, go.
अरे कनिका बाहर है। अरे समझ
Now find out what it is. Okay, go. Let's not. This class has become very. The class has become very rowdy now. Give us Tarun's phone also. He's also looking down. He's also looking down. Give us his phone also. Give the phone here. Give it here. Put it here. Go back and just bring them back quickly. Okay. Put it here. Put it on silent and put it here. My phone shop is doing great business. Okay. All right. All right. Okay. 1 minute. This is OTC, but let's go to futures. Okay. So what is your futures? We'll start with. We have given you a reference of 2.1. Okay, guys. Now we are not going to start futures contracts because you're going to be using futures contracts for your project. Okay, so you have to understand futures contracts very well. Please study these projects. I've given you the 6 contracts. Okay, what I'll do is I'll leave out the euro dollar because you guys have a lot of other, you'll have to, let's at least deprioritize that. We won't be using the euro dollar, but we will have it as part of the, this is why I tell you to always say, if you are referring to the currency, if you're trying to refer to the currency, that is, if you're trying to refer to this, okay, then you should always use the word, your expression should be, yeah. Then you let her go. Then you tell her go. Okay, take her. Go. Both of you can go. Okay, but when you see Yash, send him back. Yeah, I don't think you need Yash also to take. Okay, send him back. Okay, so this is why I keep saying that if you are referring to the foreign exchange markets, if you are referring to euro dollar in the foreign exchange markets, you must always use the expression euro dollar FX. Okay, because there's also something else called the euro dollar, which is basically the euro dollar futures. Okay, these are futures on 3-month euro dollar deposits, which are euro deposits, 3-month euro dollar deposits in London. So to avoid confusion between the interest rate contract, which is also called euro dollars, okay, so you should always, when your intention is to refer to foreign exchange, you should always say euro dollar FX. FX will indicate currencies. So that is meant to distinguish between the euro dollar futures interest rate contract. Okay, so this we are going to discuss as part of the case and the risk management on the on the balance sheet, but we will not be using this particular contract in the project. So I've just put the others in bold. So please make sure you understand these contracts. Read all the contract specs. I'm not going to cover all the contract specs in detail. And whenever you're trading any futures contract, your responsibility is to go to the website of the particular exchange. In this case, we are dealing with a CME group because CME's group is huge. Okay, they've basically gobbled up all kinds of exchanges. They used to be CME, they gobbled up CBOT, they gobbled up NYMEX, they gobbled up COMEX. Okay, all kinds of exchanges, and it's a huge group. Actually, one of the biggest, probably the biggest exchange, company in the world. So they have all kinds of different markets. Okay, so you have the objective is always any futures contract that you're trading, you have to go to the relevant exchange and look up. If you are going to trade, let's say if you're going to trade corn futures, you have to go to the corn page and then look up the contract specifications, okay, and understand exactly what is it that you're actually trading. Okay, so you can see the full contract specs. Okay, so this is what you should be doing as an exercise in any futures trading activity. Yes, what is the problem?
Sir, what will we be trading?
You will be trading this. I've already given you contracts needed for project. Okay, so these are, maybe you can't read it here. You can read it, right? Yes. Pulkit, can you read? Crude oil, copper, crude oil, gold, Japanese yen currency futures, and Australian dollar currency futures. Okay.
Only Australian dollar.
No. There is. How can you have a market without? Can you have a market with only one asset? So Australian dollar, it is understood that the other side is US dollars. Okay, So the point is that in foreign exchange, typically the most liquid part of the foreign exchange marketplace is this actually. If you look at this, once you look at, and so when you're looking at any particular market, you will also have to see, in currencies, the most liquid part is actually the spot market. Okay, so typically when you manage risk in foreign exchange, when you manage foreign exchange risk, the preferred way to do it is used to use spot and forward markets together to manage your risk. Okay, we hopefully will have time to discuss how that works, how these markets are connected. Okay, but in this particular case, we are going to use currency futures because the accounting for spot and forward effects on this particular platform is not very good according to me. So we are going to use currency futures, and that will give you additional flavor for currency futures. Currency futures are also quite liquid, but they're nowhere near as liquid as the spot markets. This is what you can see. This is the spot market. Okay, you'll see there's some quotation differences also, so that'll introduce an additional element of complication in the Japanese yen futures contract. That will also be useful for us as a learning, as an aspect of our learning. Okay, so are you following now what has to be done?
Yes, sir.
Okay, so these are the contracts. Please study them on your own. Okay, needed for the project. Okay, so we start with 2.1, and here what I've done, what we'll do is we'll try to follow for the sake of so this topic wise notes that you have in your folder. This in futures we will refer to, at certain points we will refer to the notes, but by and large we'll just follow the textbook. Okay, where there are certain mistakes somewhere and things like that. So for that we'll refer to the book, and we need to put in some additional material. So let's go to the book and see futures, where what have we given as a reference. These are your references. 2.1. So let's start with 2.1. There may be something in 1 also, but we'll just let's look at this. So understand one thing very clearly, which will help you to understand futures contracts a little better. Futures are what? ETM or OTC? ETM. Okay, so futures are exchange traded instruments. You can see clearly that to figure out futures, we went to an exchange website, right? So this is an exchange, the CME group. I don't know where. Maybe I closed that. I closed that web page. Okay, so. So the first thing you can understand clearly is futures are exchange traded instruments. Okay, so immediately everything you learned about exchange traded markets is going to apply to futures. All right, so already now you know a lot about futures contracts, because you know how the thing is going to work. The margining system is clear to everybody, that every day's losses and profits have to be paid in, okay, and received. All right, so let's just look at it. So your reference is basically 2.1 to 2.4. Okay, so let's start with 2.1. So this is just general stuff, and also please remember all your textbooks. I'm repeating this warning once again. Okay, Garvit, try to stay awake. Just half more, 1/2 hour more. Okay.
Sir, 10 minutes, sir. 10 minutes, sir.
No. The class started at 3:45.
Sir, it will end at 5, sir.
1 minute. 3:45 plus 1.5 hours is 5:15.
Sir, but it is
1 minute. No, one sec. Don't create. 1 sec. Be quiet now. Don't create unnecessary problems. It's very clear. The class starts at 3:45. It will end at what, 5:15.
Yes, sir.
Okay. All right. Okay. So 1 minute. Now, please remember, for all your textbooks, all the 3 textbooks that you will be receiving, you already got 2. I think maybe you got the 3rd one also. That Shapiro molds. No. You got only the IPM. No, IPM. 1 minute.
Talking from the beginning, investors,
IPM onwards. From IPM onwards, you should have got 2 books by now at least. You got all 3? Okay. All 3 books. 1 minute. It's quiet. Okay. Quiet now. Now it is your responsibility in all the 3 books to dig out everything where there's a reference to Indian markets. Okay. The structure of these books is that there is some material. There's some technical material given by the foreign author. Okay. And then the Indian author is just adding the material on Indian markets. Okay, so it is your responsibility. I'm not going to teach you the Indian markets because that is just information. what is traded on MCX, SX, what is traded on NSE, okay? So that is just information, but it is your responsibility to acquire that information. That is also part of your learning, okay? Like one of your super seniors one day told me 3-4 batches back that in India we don't have any commodity futures,
Yes.
which is not correct, okay? So you must have the right information as well, all right? So it is your responsibility to read up all the Indian market segments in all your textbooks, and if you have any questions then you can ask me, all right? Okay, so I'm not going to cover that. So this is also just information, all right? Okay, please read this. This is just telling you how to read all this stuff. Okay, please read this point about the delivery of a futures contract. Okay, so if I give you a material, if I give you material, then you have to read the business snapshots as well. Okay, so read this, what happens with physical delivery. So read all this stuff. I'm not going to go into any of this stuff here.
Yes, sir.
Closing out position. So understand what is meant by closing out positions. Okay, this is sometimes also referred to as squaring a position. Is this clear?
Yes.
Okay. All right. This. Okay. Now specification of a futures contract. This is what you get from here. Okay. If you go back to your notes here, if you go back to this note here, let's look at copper. Let's look at contract. Look, please. Quiet, no noise please, no talking. Next time anybody talks, I'll have to straight away deduct marks. Don't, there's too much talking going on in the class. So here, copper contract specs. So what this book is telling you is essentially the specification. You have to understand any futures contracts, any futures contract, looking at the contract specs is the first level activity to make yourself familiar with the contract, how it works. Okay, so here obviously they've talked about, okay, the asset. Okay, what is the underlying asset? Okay, so if you know whether it's corn or frozen concentrate, orange juice, you can have futures contracts on all kinds of commodities, other financial assets. Okay, so you see all this. So the asset is one part of it, obviously. One is the contract size. This is, let's look at some of this. So the asset we know here already is copper. Okay, the particular base asset that we are talking about is copper. Contract size is the second thing. So you will read all this stuff on your own. Okay, I'm not going to just handhold you and read all this stuff.
Yes.
Okay, so you read this. Contract size is another element of the contract that you have to be aware of. Okay, what is the contract size in copper? It's 25,000 pounds. Okay, so 25,000 pounds, and then you have to look at the delivery arrangements. Okay, now there are two types of delivery arrangements that you might have. Okay, so this they are talking already about physical delivery, but understand one thing about futures contracts, which is that you can have two types of delivery. Okay, let me address this. This is already in your notes, but this you have to understand. Okay, settlement of the futures contract. How is it settled? Okay, in certain contracts you will see that this is an important point to understand. So when you're trading any contract, one thing you should notice is what is the settlement method? Is there physical delivery involved, or is it what we call cash settled, or is it financially settled? Okay, so look at the delivery mode here. If they've mentioned anything here, what does it say under settlement method? Deliverable. Okay, deliverable means this is physical delivery is allowed in this contract. There are certain types of contracts where you will see that it will say, we can look it up and see. Okay, we can look at, we'll just launch something else. S&P 500, see it's already there in your notes. Okay, let's look at this S&P 500 futures contract. This is a big contract actually. There's an E-mini version as well here. E-mini is just a contract size. They have reduced the contract size, because contract size, you know, it has a big impact on how expensive the contract is. Because if your minimum, if I force you to trade and say $100 million worth in the dollar yen market, then every time a little bit of movement is also going to cost you a lot of money. If I'm forcing you to trade in $100 million lots, okay. But if I allow you to trade in say $500,000 lots, your risk is much less for the movement. Okay, so notice the difference here. In one case, in the S&P 500 contract, what does it say here? Can you read this? Financially settled, you can read, Puneet? Okay, so one is saying financially settled, which means here you can't go, and because see, S&P 500 also has an underlying asset. Okay, so The underlying asset here in the S&P 500 contract is the S&P 500 index. So you could say that, you could technically, at first glance it may seem like, then okay, fine, I'll trade this futures contract, but when it comes to settling the contract, I will buy all the stocks in the S&P 500 in proportion and I'll deliver it. Okay, I'll deliver those individual stocks, right? All the component 500 stocks I'll deliver against the contract. Okay, so and I'll multiply it by 250 and I'll deliver it against the contract for each contract. Okay, but I'll actually deliver the underlying stocks. But actually, you're not allowed to do that because the reference asset. See, just like when you're trading copper, futures, you are allowed to physically deliver. Settlement method is deliverable, it means basically physical delivery. So against this you can see that you have the ability to develop delivery period, then you have grade. Look at this, grade 1 electrolytic copper cathodes, full plate, everything is given here. If you deliver these copper cathodes against the short position, the exchange will accept it, because in this contract it says settlement method is deliverable, so physical delivery is allowed. So in this futures contract, when you trade this futures contract, you are allowed to deliver physical copper against this contract because this contract is on copper. Okay, so the moment it says settlement method is deliverable, okay, so immediately you know that you can deliver physical copper against this contract to settle this contract. If you have sold the contract, you have to deliver. When you sell something, you have to deliver it. When you buy something, you have to receive it, and whatever you have sold, you have to deliver. So if you have sold copper using this futures contract, one option you have is you can deliver the physical copper. This is clear? So the first thing to note is on the delivery aspect of it, on the settlement method. Mainly we are talking about settlement method, okay? Whether physical delivery is allowed or whether it's not allowed. Okay, so in the case of the copper contract, you can see that physical delivery is allowed. Okay, settlement method deliverable means it's physical delivery is allowed. But here you see in the case of the S&P 500, the settlement method, it says financially settled, which means they are not going to allow physical delivery. You can't deliver the underlying stocks in the S&P 500. Okay, we will financially settle this contract, which means that we will find out how much money you have made or lost, and we will just accept that. We will accept or receive or pay that difference. It will be settled in money terms. Is this clear? Okay, so this is an important aspect of the delivery of the settlement method that we are talking about. Okay, so this is already mentioned in your notes. Let's see what else is there in your notes on the point of physical delivery. Okay, so delivery arrangements. So typically when you look at a futures contract, you will see that it has various delivery months associated with it. Okay, if you want to look at this, you can see the best example I think is crude oil, where you see lots of contract months trading. All right, what is happening here? What is the talk? Why is the noise coming from here? Okay, so when we go to a futures contract on the CME, you have various options: settlements, volume, time and sales, margins. You can look at quotes. If you look at quotes, let's give it some time to load. You'll see that it trades for, there are quotes for different months. Okay, so here, can you see the Jan, Feb? Can you read that part? Last bench. You can read Jan, Feb, March 20, April 20. You can read it?
Yes, sir.
Okay. So you can see these are, so what is this book talking about here? The book is talking about delivery month. Okay. So the point about futures contracts, which we already noted once when we were looking at futures and forwards, we noted that when you're looking at futures prices or forward prices, there isn't just one price, there are many prices. Each price corresponds to a particular delivery period. So essentially, in terms of our earlier learning, we talked about transaction dates and settlement dates. All right. So the point is that here in the case of futures and forwards, you have many settlement dates. Many settlement date options are available. Okay. In the case of futures, because it's an exchange traded contract, so it's standardized. So you will have some fixed settlement dates. Okay, but in the case of forwards, as I told you, they're OTC products, so you have flexibility, so you can actually request any settlement date that you want. But the point is that in both futures and forwards, there are many settlement dates possible. Unlike spot, which spot is basically referring to only one type of settlement date, which is usually T+2 business days. Okay, there are some exceptions. but generally it's T plus 2 business days. So that is one of the differences between spot and forwards and futures. Forwards and futures, you can have many. So you can see here delivery months, okay, and price quotes, okay. So you can see here that here you see the prices. I don't know if you can see the prices. Jan is 58.53, Feb is 58.46. You can see the prices.
Yes.
So each price is different. Each price is different, okay. So the prices for different periods are all different, okay, which will also make sense because you have concepts like time value of money, which tell you essentially that any cash flow you have it has to be matched to one. If you want to bring it to one point, you have to adjust for the time value of money, right? So prices for different maturities are all different. That should make sense. Sometimes by coincidence, by a strange coincidence, everything could be the same. Theoretically, that is also possible. You can't rule it out, but in general, you would expect them to be different, okay. All right. So this is one point about the delivery months. Is there anything specific that they're talked about in delivery arrangements? Yeah, so they're telling you where the delivery arrangements. Always notice that when you have physical delivery, you have to notice where the delivery is going to happen.
Sir,
Yeah. Yeah, okay, you can go. Okay, here when you click on, so the point is here when you're looking at delivery arrangements, they will tell you, one sec, please focus, you guys, yeah. Okay, yeah, so have you shut the door fully? Okay, alright. So please note that the delivery arrangements will not only specify the exact grade of copper. Okay, if you look at the settlement procedures, there's a hyperlink to settlement procedures. It will also tell you which warehouse you have to deliver it at. Okay, so everything is specified. You can't just say, okay, I have some copper lying in Gurgaon, please pick it up. No. You will have to deliver the copper to a particular warehouse which is designated by the exchange. Okay, so for that you click on, if you are trading copper futures and you're interested in physical delivery, you will check this settlement procedures. That will tell you, okay, where you have to deliver. Okay, all these kinds of settlement other procedures of for physical delivery, normal daily settlement. They will talk about. I think you'll have to see this for the rule book and see where exactly which exchange warehouse. There'll be an exchange warehouse, mates. Basically, the exchange will give you the specification that only delivery at these fixed locations is acceptable. Okay, so like for instance, crude oil you have to deliver at Cushing in Oklahoma, the West Texas Intermediate crude oil that has to be delivered at a Cushing storage facility in Cushing, Oklahoma. Okay, so you can't deliver it even in the US. You can't deliver anywhere else. So natural gas has to be delivered in Louisiana, a place called Henry Hub. So they have these fixed locations. They will specify what grade is acceptable. They will specify which warehouse is acceptable. So you'll have to deliver, if you want to deliver physical delivery, you have to deliver only to those exchanges. Okay, is that clear? Okay. All right. Okay, so what else are we doing here? We are still hearing lots of noise. What is happening? No noise. Just be disciplined for 10-15 more minutes. Okay.
Yes.
All right, guys. So what is saying here? What are they saying here? Place will be specified by the exchange. Okay. You can see various delivery months. Okay. Price quotes, price limits. Okay, so there is something called a price limit and a position limit. So every exchange, because they don't want excessive concentration and people manipulating the market, so what they do is they put some position limits also in place, that each person can only hold so many futures contracts. But this will not be a problem for you because most individual speculators don't reach that kind of limit, and even your project balance sheet is quite small because our account equity is quite small. So I had to reduce the size of the balance sheet this time to trade, because earlier we were using OTC markets. This time we are using a different software, so our equity is much smaller. So I had to reduce the size of the balance sheet. So, but understand price limits and positions. The position limits is exchange puts a limit on your position size. You can't be more than, let's say, 5,000, any X thousand contracts, long or short. No person can be more than X thousand contracts, long or short. There will be one limit. Price limits, you guys have heard of some of you worked on in equity brokerages. You heard of this circuit breakers. limit down, limit up, NSE. Okay, I think I don't know what they're using, 5%, 6%, something like that. Okay, so they'll have some maybe 10% or whatever. Okay, so they will have, every exchange tries to set some limits. So what they will do is basically they'll try, for every contract they will set some kind of position. Some contracts don't have position limits. Okay, not every contract will have a limit. In India, maybe everything has a limit because we are afraid of free markets. But internationally, not all contracts have position price limits. Some will have and some will not have. Okay, so you have to be also aware of price limits, whether there is any price limit on this. So for instance, let's check in copper. Is there any price limit? Price quotation, trading hours, minimum price, fluctuation, listed contract, settlement method, termination, position limits, price limit or circuit. They've got some price limits. Okay, so you have to check these price limits by clicking this and finding out what are the price limits in copper. So these are some of the checks that you have to do, some of the checks that you have to perform. Okay, and you can see here what happens. Okay, what they've told you. Read this here and try to understand what is the meaning of price limits. Okay, so essentially what will happen is if any of the limits are hit, trading will be halted. Any of the limits being hit, trading will be halted. So they're actually telling you, please be aware of the price limits. So these are some of the checks that you have to perform if you're trading in any futures contract. Okay, another beauty of OTC markets is, in OTC markets, since they're not very regulated, there are no price limits. So you can have massive moves in OTC markets, like in OTC foreign exchange markets. There are no, I've seen massive moves, okay, which because there are no limits. There's no exchange to limit the price moves. It's a free market, okay. So, but here you have price limits. Many of the contracts on exchanges will have price limits. So what will happen essentially is, whatever be the price limits, you don't have to memorize the price limits. But if you're trading a particular contract, you should be conscious for that particular contract. A, does it have price limits? If it has price limits, what are the price limits? Okay, and how much has it already moved? Maybe it's already moved. Maybe the price limit is 5% either way, and maybe the price is already moved, and there'll be a reference price set here. Okay, so price limit is the maximum price range permitted. Okay, when markets hit, the different actions occur depending on the product traded. Okay, markets are temporarily halt under the limits can be expanded, etc. So the reference price you can see on all the gold price thing, the limit prices. Yeah.
Can you please explain the price limit for an example?
Yeah. So for instance, here if you see, okay, so here what I've given, 14,598. Let's look at. So the main idea behind price limits is that the exchange wants to control the price movement. Okay, unlike OTC markets which can move dramatically, nobody's going to control anything. Okay, so like when I don't know if you guys have heard about the Gorbachev, I actually got caught in that time when I was just had joined the market. But the point is that in OTC markets, okay, if the price moves dramatically, there's nobody to control it. Okay, you can have massive moves, you can have massive gaps also. Okay, so when you have market disruptions, like there was a coup in Russia in 1992. Okay, when the Russian army types, basically their KGB and army types, they tried to get rid of Gorbachev. You've heard of Mikhail Gorbachev? He's a Russian leader who was responsible for relaxing the restrictions, and many people many of the communists blame him for the collapse of the Soviet Union. Okay, so the army tried to take him out. Okay, and there was a coup in Russia for 2-3 days. So then the dollar started rising dramatically in the foreign exchange markets, and there was no limit. It just started shooting up, like 5%, 10%, like that in a day, in a few hours. Okay, so there's no limit. But in the exchanges, what they're trying to do is they're trying to limit dramatic price movement. So what is the price we looked at? 14,598. Okay, and let's put 5% on this. What is happening here? Who is this now? I have to finally deduct mark. Who is this? Saloni. And whose voice is this? Constantly hearing a voice. 14,598. Is that 14,598? 14,598, and let's put 5% of this. Yeah. Okay, so that's 730 basically. That's what they've shown you there. Okay, so what they're saying is if they have a reference price, okay, which is very close to the gold price now. We've just gone into this, right? So let's look at, of course, this is gold futures. So it's 1437 and they've got a price of 14,590, 14,600. Okay, so what they're saying is this 730. So they've set this reference price. Okay, they don't set it every day. So they've set this reference price. Now, if the price moves by 5% either way, they will stop trading, which is this 730 amount around this reference price for the gold futures. Okay. So they have different, depends on, these are all the different contract months. They have not written it in English here. These are the contracts. So another thing you notice about futures contracts is these are letter codes. These are meant for, like Z is for December. I also don't remember all the codes. M is for March, I think.
Yes,
or M might be for June, but I'm not sure. But Z is for December. So these are different. These are all month contract codes. These alphabet letters are all contract codes, month codes basically. So different months they have a different reference price. Okay, and so you have different amounts. So if any of these futures contract months that you're trading, okay, if they move plus minus by this amount, the trading will be stopped. Okay, the trading will be stopped and they'll try to see where there'll be procedures written down as to whether they'll be stopped for the day or they'll try to bring it down. They will reopen again and see whether the market comes back to normal trading ranges or not. Okay, so basically what can happen is if you have price limits and you are going long very close to the 5% limit, maybe it's already moved by, you know, say 4.5%, and then you're going short at that point. And if it actually moves a little bit beyond the 5%, then they'll halt trading. So you'll be stuck in a position where basically we say that these are the terms that we use. The market is locked, limit up or limit down. Because the market is locked, the market is not functioning. Okay, there's no trading, so you can't get out. So you're short now and the market is locked, limit up, and you can't get out. So sometimes it will happen in commodity, especially in commodity futures. It can happen that the market is locked, limit up like 3-4 days in a row. Because in commodity futures you can have tremendous volatility, like you can have crop failures. In coffee you can have a frost in Brazil. Okay, there's a frost in Brazil, Colombia, where places like that. You can have very big moves in commodity futures. So you might have a coffee contract which every day is opening and going locked, limit up. So if you're stuck short in that kind of market, are you guys following what is going on?
Yes.
So if you're locked, it's like you're locked in this kind of a market and the market is going up every day, lock, limit up, opening again and going straight lock, limit up, because there's so much excess demand that the market can't function basically, and it goes straight to lock, limit up. And so then you are going to be in big trouble, because eventually when the market starts trading, normally the price would have moved very significantly. So you don't have a chance to execute a stop at a reasonable price. So these kind of risks, these are all aspects of risk. Okay, especially when you're trading commodity futures, you get massive volatility also on commodity futures, but you also have massive risks.
yes.
Okay, all these are examples of risks. So and in OTC markets, the beauty of the OTC markets is there is no price limit. Okay. Okay, conversions of futures to spot should be 1 minute. Let me see if there's anything else here. No, we have this is the futures contract. Okay, let me make sure that I've covered everything for physical delivery. Okay, so for physical delivery we look at please read this business snapshot also, as we have this BS is business snapshot. Okay,
Yes,
so 3 contract sheets. So I've already explained this part. Okay, that some will have financial settlement, okay, what we call cash settled, and some will be settled through physical delivery. Okay, so now, okay, so in the case of physical delivery, now here there are 3 important concepts which you have to understand. Okay, which we will just try and cover this before we finish today. Please try and understand. There's a mistake in your book actually. Okay, in this there's a mistake in the book which I've written out. Yeah, so I don't know if it's showing in the ebook version. It may or may not. I think it's there in your written book as well. So first notice day definition, just ignore the book definition. Just go with what we have given you from the CME website. Okay, so there are 3 important concepts that we'll study today before closing. Okay, very easy to understand. The 3 concepts are,
Yes, sir.
1 minute. First and last, 1 minute. We'll just cover this and then move on. Okay. First concept is position date. Position day or position date.
Yes.
Okay. First position. So important concept. Last trading day. First position date. We'll first understand what is position day, what is notice day, and what is delivery date. Okay. So for physical delivery futures, these are very important. So the mistake that they've made in your book is actually they have described first position date and they have called it first notice date. So you should understand the difference here. What is happening? Quiet. What is? 1 minute. There's the difference between what is the first position date. Very simple. The first position date is the first day that the holder of the short position. This is all in your notes. Okay, you don't have to memorize. You don't have to write it down. You just have to understand the concepts. The mistake in the book, you should be able to understand the mistake in the book also. The mistake in the book is they have actually given the definition for first position date and they have called it first notice date. Okay, that's actually a mistake. First position date is the first day on which the short position holder, so I've shorted copper and that's the first day on which I'm in a position to tell the exchange that I'm going to settle this through physical delivery.
Yes, sir.
Before that FPD, I can't do that.
Yes, sir.
Before first position date, I can't give that notice to the exchange. Okay, first position. And last, you understand. First notice date is the first day on which the exchange can tell the long position holder that you are going to be delivered against. Okay, if you are long, that means you should make sure that you get out before first position date, first notice date. Because as soon as first notice date comes, the exchange can catch you randomly and tell you that you are going to be delivered against your long position. Now you have to accept physical delivery. That story about cattle futures, you read that story, that's what happened basically, right? First notice day. So if you have a long position, you don't want delivery, make sure you get out before first position date,
Yes,
first notice date. Okay, this is clear. First notice date, last delivery day, first and last delivery day are the days on which delivery can be made. Okay, so please complete the rest of your reading so that we can quickly finish the futures segment and then we'll go on to the case. Okay, yes.